Stocks trade firm after hope of a Fed rate cut keeps US equities upbeat. Industrials and autos notch some gains while FMCG and realty soften.
The board of Infosys has approved an 18,000 crore share buyback, its biggest till date and almost twice the size of its previous three buybacks. The tender offer price at 1,800 rupees is a 20% premium to Thursday's closing price.
Veteran investor Manish Shokani says the market is being held up by price-agnostic retail flows even as PE and promoters sell down. A turn in sentiment, he adds, can hurt investors with a less than 3 to 4 year horizon and over 15% return expectation.
US Commerce Secretary Howard Lutnick tells CNBC he is focused on a deal for India, but India needs to open up and stop buying Russian oil. Indian Commerce Minister Piyush Goyal reiterates the first tranche of the US trade deal should be stitched by November. You're watching us here on Halftime Report on CNBC-TV18. I'm Mangalam Malu. With me, Ekta Batra and Vinny Motiwala. We come to you live from the CNBC-TV18 Motilal Oswal studio. And what a good day it has been for trade. The 8th straight session for the Nifty gaining and now comfortably above that 25,000 mark as well. In fact, inching closer to the 21st August levels of, Prime Minister Narendra Modi's post-Independence Day speech level of 25,154. So that'll be an important mark to watch out for. Broader markets doing well. The Nifty bank above 20-day moving average. So far, all is well.
Well, kissing distance, you'd have to say, from those levels on August 21st at this point in time. But yes, as you can see that the Nifty has gained that momentum. It's up for the 8th consecutive day. And week to date, that's actually telling enough in terms of the kind of move that the markets have made. So on a week to date basis, the Nifty is up around 1.5%. We have the mid-cap index, which has rallied around 2%. The BSE small cap index is up around 1.5%. And surprise, surprise, the Nifty IT index has really made a comeback this week, up around 4% at current reckoning. So all that going good for us. Let's see whether this sustains. But as of now, the noises seem to be correct when it comes to the India-US tariff negotiations as well. So all of that aiding in terms of sentiment. Hi, Vinny.
Hi, good afternoon, guys. So yes, absolutely a good day coming in and a good week also, because this will be the second consecutive week that we'll see the markets close on that positive side and Nifty close, with gains. So that'll be interesting to watch out for. Auto and pharma today are the top sectoral gainers. We'll be keeping an eye out on, these sectors, and we'll get more stock specific later on the show as well. But let's get started with the show and talk about some of the deals that have been happening as well. But in terms of JBM Auto, I just want to highlight that, before we go to more deals, JBM Auto, that's the one buzzing, right? 10% uptick that we're seeing coming in for the stock right now. And obviously, there's news flow, which is keeping the stock abuzz. Apart from that, keep an eye out on these capital market names. Nuvama Wealth, that's buzzing again in trade today. With BSE, that's managing to hold on to some bit of a green as well. So that is what we'll keep an eye out on. And that'll be interesting to see what actually happens in terms of that consultation paper that is going to be going on, and that is the key to watch out for in terms of these capital market names.
Right, and as we speak, the defense names as well are back in vogue. So we have BEML, which is up 7%, Garden Reach Shipbuilders up 7%. We're seeing big traction come by on some of these other names as well. Bharat Dynamics, for instance, up around 5.5%. Paras Defense, too, is up 5%. But Lupin, that's the stock on our radar. Ekta, Investec betting big on Lupin?
Yes, absolutely. So they've upgraded the stock to buy from hold, and they've raised the target price to 2,265 from 2,100. They say it's well placed to ride the upcoming GLP-1 opportunity in India. Lupin is a key player in terms of the anti-diabetes and cardiac arrest therapy segment. Recent approvals indicate Lupin's expertise in complex injectables. They expect to see potential of $20 to $30 million annual sales for each injectable. Post the recent correction, they view valuations as reasonable. Base case, a strong FY26, moderation in FY27, and EPS growth resuming in FY28. So that's on Lupin. That stock is up around 2.6%. But we have a larger topic to discuss now, and that is on the outbound M&A from India Inc. India Inc. is going global. What's fueling the overseas M&A? Nimesh is here with all of the statistics, all of the details and the numbers at the wall to tell us more. Nimesh.
Well, Ekta, as you rightly pointed out, the India Inc. has been on a shopping spree. It's not been only this year, but since last year as well. But this year seems to be standing out so far. Already in 2025, since in the last 8 months itself, we've seen M&A deals of almost 100 deals have been done, and the value is over $1.5 billion. So that's the kind of deal value, and the number of deals that have been stuck in 2025 itself, which means in the last 8 months, this is the kind of M&A deals that we've done. Just to highlight some of the notable names which have come out with the and essentially this whole M&A deal has been done to play on the global supply chain. So that's the key theme on which a lot of Indian companies are doing M&As. Top of my mind is Tega Industries. A big deal got announced. I've been tracking this for a while now, but $1.5 billion, that's the size of the company which they've acquired, which is called Molycorp, that they acquired, and they've announced the deal very recently. So that was one big deal, Outbound, which got announced from a mid-cap company. Tata Motors was another deal. They've acquired an Italian company, and that's the deal size for Tata Motors as well. And Sudarshan Chemical, we all know, they closed the deal in 2025. Again, a big deal. By virtue of which they become the second largest player in the pigments industry, that is Sudarshan Chemical. So these were the few notable deals which were recently announced from the Indian companies, especially the mid-cap Indian companies, the likes of Tega and all. But the list is quite long, right? And there are so many prominent names in this list which have done globally, which have done and acquired companies globally. Wipro stands out, Titan stands out. Titan, Mangalam tracks it very closely. Aurobindo Pharma and Natco Pharma. Ekta, you've been tracking that space. So across autos, across IT, across auto names, you're going to see this kind of deals happening. C8 was another example, a big deal that they announced earlier this year, $225 million. That was large one. Sun Pharma, TBO Tech. Again, a small cap company, but they've done a big acquisition globally. And so is Eicher Motors as well. So, as I said, across sectors, we've seen cross-border M&As picking up. I spoke to some bankers as well. There seems to be a confidence now back for mid-sized companies to go out and acquire assets globally. The other important thing is, we are seeing a lot of deals from the Europe, essentially because there is so much of trouble. So you can see a lot of buyout deals, especially from Europe as well, because there are a lot of stressed assets there as well. Again, there is a lot of support as well. The domestic money is so large that that's helping. In fact, I spoke to Tega, just after the deal got concluded, and he said the first time he saw the deal in 2017, but that time he didn't have the currency or the money power to chase it. Now they could do it, and that was one of the large deals. So almost, if you just do a comparison to last year, 2024, there were 121 deals all through the year, valued at $17 billion. And I just said, in the first 8 months itself, we've seen over 100 deals, and that value is close to $11.5 billion. So M&A is really picking up, and especially the outbound M&A from mid-sized company is what there is a lot of traction going on from the India Inc., and they've been looking at assets globally.
Okay, Nimesh, thank you so much for that. Very, very interesting data points coming in there. And look at the size, right? Nimesh just showed it to us as well. Already 100 deals in the first 8 months, and the value is already $11.5 billion. So that is something we'll be watching out for. But to talk about this and, where is now all this going to be headed in terms of deals for India? What are we watching out for? We have Vivek Gupta, partner, M&A and PE leader at Deloitte, joining us to discuss all of this. Vivek, good afternoon. Thank you so much for joining us on the show. And, let's start by just talking about the size of these deals, right, that have been coming as well. They've become much larger now in terms. How are you seeing in terms of size of the deals going forward? And do you think now companies are going to be focusing more on these outbound deals where they'll get a leg up even in terms of value chain, just apart from, looking at the geography expansion that they'll get?
Look, this is a trend that one has been seeing for the last 3-4 years. The fundamental macro factors are in favor of the Indian companies. They have access to finance, which is much cheaper than earlier. They have local currency, as you mentioned just now. They have local currency in the form of equity, which can be used to generate the money flows that are needed for doing deals of this size. You mentioned $11.5 billion for 2025 so far. And while deal activity tends to be transactional, our Deloitte estimate on the quantum of outbound investment deals that are likely to happen over the next 2 to 3 years is $30 billion annually, much higher than what we've seen in the past. And I think companies will continue to shop for larger ticket acquisitions as they see access to finance and as they see access then to markets or to supply chains. The traditional sectors that we've seen historically are pharma and IT. I think now we are seeing companies willing to acquire in other sectors like industrials, auto, etc. So we continue to be very sanguine on the fact that the trend that we've been seeing for the last 3 years will continue. $30 billion odd of outbound investments, of outbound acquisition investments, outbound M&A from India Inc. is something that's on the radar.
Vivek, thanks for joining in. I know you've been tracking this space for more than 25 years now, one of the senior banker there. You spoke about $30 billion, the size of amount that can happen annually. If you can just identify for us a couple of sectors where you think there is prominent interest from the Indian companies, and there are a lot of assets which are available as well. So a good match for Indian companies and stress assets available globally. So if you can just highlight some of the sectors where there could be a lot of interest.
The interesting trend is, and I will answer your question, but the interesting trend is it's not just stressed assets that India Inc. is after. India Inc. is now happy to pay for assets, pay value for assets and purchase them.
Wow.
As I mentioned, in terms of sectors, the traditional sectors always used to be IT and pharma. I think we are seeing a bunch of assets now in the industrial space. We're also seeing a bunch of assets in that space, which is the cusp between consumer and pharma. So not really regulated pharma, but OTC consumer pharma as well, where deals beyond $1 billion in size are on the anvil. So I think IT and pharma will continue to be strong sectors for Indian companies to purchase, but I will now not be surprised in seeing deals in other sectors like industrials, part consumer, and so on and so forth. India, with the currency that it enjoys now, can actually buy overseas at decent value.
Sure. Vivek, you spoke about pharma as one space. Will you be surprised if Aurobindo, if they loses out on Zentiva, they go for another large acquisition? Is there something that is available globally, a very large pharma asset up for grabs?
I will not comment on what Aurobindo will or will not do as a specific company, but I will generally say that yes, across the globe, there will always be interesting opportunities in the pharma space for acquisitions. I think there's a natural confluence of capital from India and these pharma companies with operations globally, and that will continue to be a sector which will be of interest to the Indian pharma companies.
Okay, so Vivek, I just had a question which was similar to that, and it's an offshoot. It's a $4 billion deal, whether or not Aurobindo buys it or not. Is the market ready to accept such a large acquisition, say across the sector, to give it, to put it into perspective, a company biting off possibly more than it can chew? But are companies or is the market ready to digest such large acquisitions? Because for Aurobindo, it's a $4 billion acquisition. There were concerns in terms of the size. There were concerns in terms of funding. And there was a little bit of a relief, when there were indications that they might not be the bidders.
The ability of the market to understand acquisitions is very fact-specific. So if I have a situation where a company is buying another company which is larger than its size, so long as there's an integration plan, so long as there's a robust financing plan, and so long as there are cash flows available to service that acquisition, I don't think the market has any trouble. At this point in time, the market is betting strongly on the Indian entrepreneur and the Indian growth story. So I would not go so far as to say the market will have trouble understanding in principle larger deals by the Indian companies. But of course, whenever there's a large deal, the threshold to convince the market is higher, which is, the threshold is, yes, I can finance this without undue risk to my core business. Yes, I'm doing this because this makes synergistic sense with my existing business. And so long as that story is clearly stated, I think the market is able to grant a lot of latitude to Indian businesses in terms of their global ambitions.
Well, Vivek, the fundamental story is fairly clear. Yeah, there are synergies. There is this opportunity outside of the country. It's more than just, looking at distressed assets. There are synergies in merging. What I was curious about, and it was an incredible list that Nimesh put out of all the marquee deals that happened. All of them, nearly all of them, barring one or two, were done in cash. At a time when you have global companies cashing in on their Indian chips to be able to buy their own, the valuation differential between the two, would it not have been a little more prudent to use their equity as currency as against cash?
Look, and I say this often, right? I think using cash is smart because you choose the amount of equity dilution that you want to do at a particular price. B, using cash is a combination of equity and debt, right? Most companies that were mentioned on the list actually would have done a QIP or some cash raise to fund the equity component of the acquisition. So effectively, they've used the Indian equity currency, but they're offering a cash deal to the seller so that the seller is then not exposed to the Indian equity market risk. The seller may basically say, look, I want this cash. And it's easy for Indian companies to generate cash on the equity stock markets through a mechanism such as QIPs. So a large component, I think, of the deals that you mentioned in the table that you showed are deals that were funded by a combination of debt and QIP-based equity issuances, which is exactly the same thing as using equity by giving it to the seller. It's just a function of who holds your equity.
And the investment bankers who get fee for both.
Vivek, one last question to you, Vivek, before we let you go. I'm just taking some names and I want your view from an investor perspective. What should investor watch out for? For example, the Tega deal. A $1.5 billion, the acquisition is bigger than the current size of Tega Industries. Similar was the case with Sudarshan Chemical as well. They went out and bought a very large company. They'll become the second largest player globally. From an investor perspective, Vivek, what are the things that investors should watch out for? Where can the companies falter? And which are the few red flags that you want to highlight that as an investor one should watch out in such large transactions?
I think, look, again, without specifically talking about companies,
just an example.
In any such acquisition, the first and most important thing to watch out for is what is the financing structure of the deal. Sure. If the financing structure of the deal is such that it does not expose the business to undue risks, then I think it is a deal that passes at least the financial test. The second and most important thing to watch out for is ability of the management to synergize and integrate. Sometimes deals are often induced by egos, by the sheer desire to become larger. I think the disciplined case on how the deal adds to synergies and how the deal can be integrated, coupled with the management's ability to be able to make that deal successful, is the second thing that I'd watch out for. So financing structure, core business synergy, and ability of management to successfully integrate the deal are the watch points, I think, for investors. And that is what the market typically ranks any of these deals on.
Sure.
Okay. All right, Vivek. We're going to let you go on that note. Interesting conversation there, and I'm sure.
Perspective as well.
Yes. Thanks, Vivek, for joining in, and thanks, Nimesh, for bringing us all of that comprehensive
data. This is something which I track very closely. It's close to my heart, and I love tracking M&A deals.
Close to your heart, is it?
So I think it was good to get a perspective from someone who's so senior. Yeah. And this is exactly what in a large M&A transaction, how they're going to execute the deal and not the risk to the current core business.
Yeah.
That is something to. And Tega is a classic example. He's clearly mentioned that he looked at this deal way back in 2017, but that time he didn't have the money power to chase it and close it. Now they're going to make an announcement of a preferential issue as well. So they're going to raise money via equity, use that money as well, use the global parent's balance sheet to raise debt. Similar thing, something which even Sudarshan Chemical did. So in a way, I think some of these Indian companies are getting smart, doing it nicely, smartly, and using the equity as a currency to go out and buy.
The point that he made, that you're using equity as a currency for current shareholders, but paying cash to the foreign companies that you're buying so that they don't have any risks to the Indian equity market.
So we've definitely come of age when it comes to Indian outbound M&A. But $17 billion in 2024. Eventually, Deloitte is estimating $30 billion in terms of outbound M&A for Indian companies. So good going for us. And it's reflecting on the stock markets as well at this point in time. We'll take a short break, but we'll get you more on the markets. Lots of stocks, lot of discussion around the consumption theme once we're back. Stay tuned.
Welcome back. Ever since the GST rate cut has been announced, or the possibility of that has happened, we here on CNBC TV18 have been tracking the consumer space very, very closely. So we're now, looking at it as the consumption centimeter as we build towards the actual activity of, the cuts of the GST rates. That happens on September 22nd. And ahead of that, Goldman Sachs has written a very nice note on the sector post-GST rate cut, indicating that companies across the board may have anywhere between as low as 100 basis points to a 1,200 basis points reduction in their blended GST rate cuts across their coverage. And then there is that, table that comes up for you on the screen, which lists company and their GST rate cut impact and the potential EPS upgrade that comes in over the next couple of years as well. So that table comes up for you on the screen. The author of the table, Arnab Mitra, who is the India consumer analyst at Goldman Sachs, joins in as well. Thanks a lot, Arnab, for joining in. It's a wonderful note, that you've put out. You expect disruption in the second quarter. You expect volume growth to return in the second half of this year. The question is, how do you expect companies to pass on these cuts across the portfolio, and by when? Because if it's just price changes on the MRP, new packages come by. But large part of the market, you and I know, is, the price point market. And we've had managements tell us that grammage changes are a lot more difficult to pass on than just price changes. So when is the earliest you expect these grammage changes to come to the street by? And how do you expect the companies to pass them on at the earliest?
Yeah, thanks, Mangalam, and thanks for having me on the show. I think one of the big differences between the GST rate cuts this time and what happened 10 years back in 2017 is that while the government has said that companies should pass it on to consumers, and I think companies are committed to pass it on to consumers, there is no strict anti-profiteering law like there was 10 years back. As per the 2017 anti-profiteering law, companies were required to pass on price cuts in every single SKU or pack that they sell across their portfolio, compared to this time where we feel there's a lot more flexibility. So ultimately, companies will pass it on, but the manner in which they do it across their category may be a little bit more flexible than in the past. So what we expect is the price corrections will land in the market, as you rightly said, after 22nd of September. We'll start seeing new MRP stock in the market. Of course, there is always a transition issue with higher MRP stock already lying with distributors and retail, which is where there could be a little bit of a pipelining issue towards the end of this quarter, which will be a short-term impact reverse in the October month. The grammage cuts, our view is for different categories differs, but could take a month and a half because of the changes that the calibration of factories have to happen. But around November, we should be fully seeing the new MRP stock plus the higher grammage stocks across categories land up. And that's when we will start seeing the impact on volume growth, revenue growth, earnings growth for these companies to flow through.
And
Arnab?
what's your estimate on the volume growth in the second half of this year? Once you believe that, it'll come by, how much incremental volumes are you expecting? Let's put it that way.
Yeah. So if you look at how volumes will get impacted in the category, there are basically 3-4 main drivers. One is price point packs. In price point packs, when the grammage increases in a certain 1 rupee sachet of shampoo or a 10 rupee packet of biscuits, it gives you straight away higher volume growth because the consumer will end up consuming a single serve pack or a single biscuit, even if it is slightly bigger in size. The second is there is this unbranded to branded transition, which can happen in categories where there is some unbranded share. Third, actually very importantly, is premiumization. I was going back to my notes of 2017-18, and one of the biggest catalysts of GST cuts that time was premiumization. So as prices came down, consumers were able to move to a higher brand. Companies also very smartly sometimes can use recruiter packs of big brands or premium brands and drop the prices even more than the larger packs, which leads consumers to upgrade. And the last is there is some demand elasticity of price elasticity of demand. So I would expect anywhere between, depending on each company, but let's say if there's a category where GST has got cut from 18 to 5, I would expect anywhere between a 3 to 5% increase in volume growth of that category. However, then we have to account for the fact that everything has not dropped for each company. The portfolio could be different, but that's the broad range of outcomes which we have built in this estimate that you've shown here.
Sure. Arnab, just wanted to drill down to stocks specifically because you are estimating that Nestle, Britannia, as well as, say, the likes of Dabur and Emami are probably going to see the maximum upside in terms of EPS, 5 to 10%. Incrementally, what would be the impact in terms of earnings for them? Would this sustain according to you, going forward, going into probably the next fiscal? And how are you placed specifically on these stocks in terms of a rating?
Yeah, I think one of the things that makes us quite positive on the sector is that we were already getting positive on mass consumption before the GST rate cuts happened. So we put out a report about a month back talking about a mass consumption revival, which was coming out of the lower food inflation, the government stimulus from the state governments, income tax cut, all the other catalysts. GST actually is the biggest of the lot in this series in terms of the absolute size, the impact it can create. So one is the reason why we feel this is not a one-off bump, but actually probably catalyzes the recovery because there were other catalysts also. Because sometimes, when things are already deteriorating and you get a cut or a stimulus, it doesn't immediately help. But when you're already improving and there are other catalysts, it becomes a lot more potent. So I would expect some of these gains to actually sustain. It could be the catalyzation of overall consumption recovery for mass consumption, which has been weak for many years. Now, on a company-by-company impact, of course, I can't talk about specific stocks here, but the reason why we looked at earnings potential upside is that we also don't know whether companies will use it to increase EPS in the first year, or do they want to invest it back to further accelerate volume growth? Like a company could have a choice of delivering a certain volume growth and a certain EPS growth, or may choose to invest back and improve the volume growth even further. But if we look at 2 years out or 1 year out, I think this is definitely a permanent benefit. It resets the growth trajectory and the earnings trajectory of these companies, which has been very weak in the past. What we've shown in that analysis is how much is the potential upside if the company were to retain some of these benefits. And then, of course, it's their choice, which we will hear over the next 3-4 months from companies on how they should pass it on.
Arnab, what about Colgate or toothpaste companies, right? Single category companies. You're highlighting about that. The concern comes in on input tax credit over there. So what would that impact be? And are there any such other categories that one should watch out for? Maybe where we could see a bit more of an impact on the negative side.
Yeah, I think any company which is a single category company and where the GST has dropped from 18 to 5 and where input tax credit was more than 5 in the past will have this challenge. This also very interestingly opens up a differentiation between companies. So let's say there's a company which has one single category and gets a GST cut versus a company which has many categories and gets a GST cut. There is possibility to offset the input tax credit against other categories that they sell. But in single category companies, it becomes a standard GST. Their ability to cut prices is lesser than the competitors who have broader based categories. And we also don't have clarity whether the government will have some mechanism to refund input tax credit. We will have clarity over the next few months. So there could be some challenges there. The other thing we've highlighted in the note is the state government incentives. So many companies have set up factories in states where they used to get a refund of the state GST. Now what's happened is just mathematically the state GST is dropping from 9% to 2.5% in many categories. So the component of refund goes down, which is actually a core part of their pricing strategy today. So we will have to just watch out for these two specific impacts, which is input tax credit and state incentives, which again will differ a little company to company. The more broad-based the company, I think the better chances of mitigating these factors.
Just a final question before we let you go. Arnab, you said that this will catalyze volume growth more than all the other announcements that have come by in the past. But, from an underlying macro trend, from what happened when the GST 1 was announced versus GST 2.0, we have the D2C companies, which are eating into the shares of these companies from the premium end. The prospect of unorganized to organized, we've seen that a large part of that shift take place in the last 5 to 6 years already. So that headroom also perhaps may not be as much. And between the first time it was announced to now, the valuation multiples of these stocks have also gone higher, while the growth has only come lower. So do you think this announcement will only just be a temporary booster, or glory days of large cap traditional incumbent FMCG companies is ahead of us rather than behind us?
I think you make a lot of very good points. I think the starting point of valuations is higher, so we cannot expect, the kind of upside we saw 10 years back in some of these stocks. But on the other two elements, like let's say D2C companies or digital companies, that's a factor very specific to the beauty category. We've not seen too much of that in many other segments. In other segments, actually, the other challenge has been regional players and local players who have gotten stronger over the years. There, we also feel macro played a role. I mean, when the consumption demand is so low, when your real rural wage is not growing at all for year after year, the consumer was trying to lower the household budget. And there was an active downtrading in many categories. Tea, for example, is a good example where actually downtrading to loose tea had happened. Now, as the GST rate cuts come through, your affordability increases, your gap with unorganized sector further reduces. I think the chances are that some of these trends will also reverse. So we don't expect it to go back to the glory days of 2000, let's say 8 to 12, but significantly better than the last 5 years, which has been really anemic growth for the sector. But it should be a significant change in the trajectory is what we are looking at it. And as I mentioned, it's multiple things. It's not just GST, but GST is the largest of the 4 catalysts that actually have come through. And we think the street is probably slightly underestimating the impact. In our conversations, there's a lot of skepticism whether this can really be a big catalyst. But I feel bottom up, it looks like a much bigger factor than any of the other catalysts we've seen in the past.
All right, Arnab, thank you so much for joining in and giving us your views. Always a pleasure speaking with you. We'll keep our conversations more frequent, and we'll obviously keep getting a dipstick on what's taking place on the ground from your good offices as well every once in a while. Take a short break, come back, get you more on the markets and a lot of other stock-specific action. Stay with us.
Welcome back to Halftime Report on CNBC-TV18. Nifty as of now comfortably about 25,100 levels. We'll keep an eye on where that's headed. As of now, 0.4% of gain, 100 points uptick for the Nifty 50. A lot of individual stocks in the last 1 hour that have been moving. Just pull up Hind Copper. That's up 2% just in the last 1 hour. So that'll be interesting to see, as well as Graphite India. That's also seen a bit of a spike up. So keep an eye out on that. But we have Vivek joining in with us now to take us through the important stocks that are moving around in today's trading session. Vivek.
Well, thank you so much for that. Looks like we could see 8 successive sessions of up move as far as markets are concerned. Broader end of the markets are very, very strong, and the advanced decline ratio is very positive as well. What's doing quite well? Well, the entire pharma pack today seeing a bit of buying. Lupin, of course, on the back of the Investec upgrade is leading the pack almost 3% higher, but the remainder of the names, or the rest of the names, too, seeing some buying activity emerge after a while. Hindustan Copper, a stock you just mentioned. So what's actually happened? Overnight, the company has gone ahead and uploaded an investor presentation. They've outlined aggressive, ambitious capex plans. Some important approvals is something that they're talking about. Stock on very strong volumes today. Clearly, stock of the day almost 9% higher. The capital market stocks yesterday, all of these stocks under significant pressure, 3 to 5% lower yesterday. But today, most of them have made a bit of a comeback. So names like BSC, Angel One, Nuvama Wealth, all of these stocks have seen some buying emerge or some short covering emerge after yesterday's fall. JBM Auto, one stock from the broad end of the universe. The company subsidiary has managed to secure close to $100 million funding from IFC. On the back of that, that stock higher by almost 11%. And the entire defense pack, it's been a strong week for all of these names. So names like BL, BDL, MTAR Tech, all of these stocks on very good volumes today, seeing some buying activity emerge. On the other hand, the consumption pack seeing a bit of profit booking at higher levels. Names so Hindustan Unilever, one of the top laggards on the Nifty, ECPL, Dabur, all of these stocks, Jubilant Food, almost 2% lower on that particular name. OFSS, day first raised stock higher by 10%. Yesterday, a clarification came down by 2.5%. And today, seeing further follow-on selling pressure. Tega, we highlighted the fact yesterday that this is a very large acquisition that the company has gone ahead with. Yesterday, down by almost 4%. Today, further selling pressure as the street tries to digest the size of the acquisition that the company is making. And Paradeep Phosphates is another stock from the broad end of the market that's under significant pressure today.
Okay, all right, Vivek, thanks very much for that. So definitely a very lively market on our hands. For now, the mid-cap index is holding with a gain of around 0.3%. We have the advanced decline ratio, which has cooled off a little bit. So maybe that should come up for you in terms of the advanced decline ratio, currently standing at 1:1. But as you can see, it's narrowing in terms of the gap. We'll take a short break, but on the other side, we'll continue our focus on the consumption centimeter segment. We'll be connecting with Sanjeev Mehta, former chairman and CEO of Hindustan Unilever. Stay tuned for that conversation.
This one's a very special conversation because we've been talking about the consumer sentiment post GST 2.0 on our special consumer consumption sentiment. We have Sanjeev Mehta, the executive chairman at L Catterton India, but more importantly, former chairman and CEO at Hindustan Unilever. Mr. Mehta, you've seen it all. You know, you've seen the first GST, you've seen demonetization, you've seen the pandemic period, you've seen so many regimes and their impact on consumption. So with your experience, how would you rate GST 2.0 as a catalyst to boost consumption? And with the freedom that companies have been given right now to pass these prices on dynamically in the absence of the anti-profiteering law, how do you think this would catalyze volume growth? Analysts expect anywhere between 3 to 5% incremental volumes. What would your experience say?
Yeah, thank you, Mangalam. Delighted to be on your channel, and my greetings to all of your viewers. You know, if we just, Mangalam, for a moment step back and look at the construct of Indian consumers, you have about 3% of the households who I would say have the purchasing power of the West. Then you have about 11% who are the classical upper middle class. Then you have about 30% of the households which are lower middle class or the archetype middle class, you know, people who are striving hard and moving from very clearly from needs to wants. And then you have a large percent of India's population, which is over 50%, which I would still classify as within the Indian construct bottom of the pyramid, though they are not today people who go hungry, but their household income would still be less than 300,000. Now, in the last couple of years, many things have happened. First has been the disruption of COVID, followed by huge spike in inflation. And during the period when you had about 2 years of massive inflation, then obviously at that stage, the volume growth came down because most of the companies, they had to take the price up to protect the business model. Then we also had a period when the agri growth was very tepid. There was a year when it was less than 2%. That took a huge toll on the purchasing power of people living in rural India, especially those dependent on agriculture, which we are talking about nearly 45% of the national population. Now, when you put all these things together, it is not surprising that there was a stress on consumption. But the good bit has been that despite all this, if you look at the volume growth in the industry today, certainly in the categories where I led the business, there we are seeing volume growth of in the vicinity of 6%. Now, 6% from a global standpoint is not a bad picture at all. Yes, after the high period of inflation, the price growth has now disappeared. That's in many ways a good thing because the incremental inflation has not been very high. So your entire top line growth was driven more or less by volume growth. And now we are talking about the government stepping in to give a huge advantage in terms of GST reduction. Now, we must remember that a few months back, the corporate tax rates had come down. Now, corporate tax rate, of course, is not going to impact the people in the bottom of the pyramid because their incomes are low and they are not in the tax bracket. But certainly the middle class was given a boost. And here you have now a big step taken by the government to rationalize GST and give a huge benefit to consumers. In many categories, the tax rates have come down from 18% to 5%. I think the first thing that a consumer goods company should do is they should pass on the benefit to the consumers.
Sure.
This is not something that they should look at to fix their business model or increase their gross margin. They should pass this benefit to the consumers, and that would give a further fillip to the people at the bottom of the pyramid whose real wage growth had not kept in tandem with the inflation.
Right.
And the huge
Mr. Mehta, how much do you think would it mean in terms of incremental volumes were the companies to pass on these cuts immediately to consumers in your experience?
It would be very difficult because each category has different nuances. Each category, the impact would be different. But if you were to look at that the benefit runs into over 40,000 crores, and if a large part of that is passed on to the consumers, I wouldn't be surprised if an equivalent amount of growth happens from a perspective of the consumption going up.
Sure.
But there is also one very important factor which we should never forget, which is the behavior aspect, or what I would call as the consumer confidence. When times are tough, people hold back spending money. When they look at that the government is taking series of steps, the inflation has come down, they would become much more liberal in spending. And when we talk about consumption, Mangalam, it plays in different ways. When you are at the bottom of pyramid, when times are good, every member in the family may want to have their own bar of soap. When times are tough, they might step back and say, the whole family will just consume one bar of soap.
Sure. Mr. Mehta, that's exactly where I just wanted to get your opinion about the consumer confidence. While we do have this rationalization which has come through with regards to GST, on the other hand, we do have the rupee which is depreciated significantly. And we have other factors such as the uncertainty with regards to tariffs. While we have made headway there, there is still the uncertainty with regards to what could happen in gems and jewelry and textiles, and hence the impact on employment as well. In that context, do you think some of the GST fervor and the boost is probably offset by these factors, by these negativities?
Again, we must remember that India is not a homogeneous country. Yes, there would be workers in the diamond industry who might get impacted, but they would still be a small part of the total consumption base. A large part of the consumers in the country are going to get the benefit of GST reduction. I'm assuming that the companies are going to pass it back to the consumers. So certainly there will be a fill-in, no question about that. Of course, there is an overhang. And then we must look at it from different lens. If the stock market doesn't go up because FII is not coming in, that certainly has an impact on the consumer confidence. But just look at it. We are talking about more than 50% of the households in the country in the bottom of pyramid, less than 300,000 family income. They would get a benefit. There's no question about that.
Sure. So, quick one. I just wanted to understand, what would be the main hurdle that comes in, right, to get into this transitioning phase for companies? And would we, even if they pass on the benefit, I don't think that it would be fully, right, that they would be able to pass on. If it's moved from that 18% to 5%, how are they going to be passing on that full benefit? Will it be full, or will it be through some distribution side of challenge or discounts that come in on that front? And look at categories like soap, right, where we have competition, high penetration. Why do they need to pass it on that time?
Look at it from this lens, that if your input tax doesn't exceed the total GST that you would be paying on the output, then the whole benefit flows down to the companies. And there would be a moral responsibility to pass it to the consumers. And you must also remember that these are very competitive categories. And if your competitor reduces the price and you don't reduce the price, you would become uncompetitive. So the sheer competition will also force the companies to pass a large part of the benefit to the consumers.
Right. Mr. Mehta, just one question before we let you go, and this is beyond GST and perhaps on the future of, the new leadership at Unilever. You've worked with Priya before. Your thoughts here, and obviously, the global leadership also focusing on India, saying that not more capital would be deployed outside of growth markets, and one of their biggest growth markets is India. Your thoughts?
India is the second largest market for Unilever. And when you look at it from a valuation perspective, India is the most valuable country for Unilever. So I'm not surprised that Fernando is focusing on India and the US. Those are the right calls. And as far as Priya is concerned, I know Priya well. I'm very confident that she's going to do a great job.
Okay, all right, Mr. Mehta. It's been a pleasure. Thank you very much for joining in and speaking with us. And I'm sure we'll definitely get you back on post the 22nd of September as well to get an assessment in terms of how things are panning out on the consumption front. As of now, we need to take a short break. We'll be back with more news. Stay tuned. Welcome back. Well, for the markets, 25,111 is currently where the Nifty is at. So doing well, up around 0.4%. We have the mid-cap index also, which is holding with a gain of around 0.2%. Well, in terms of particular stocks, we have stocks such as BEL, which is really topping the list at this point in time. So that stock is up around 3% We have Shriram Finance, Axis Bank, both of these finance stocks doing well, so up around 1.5% for a couple of these counters, along with autos, which are managing to have a good week. So we have Aisho, which is up around 4%, as well as Maruti, which is up around 2.8%, obviously benefiting from the GST rationalization. But on that note, it's a wrap on Halftime Report. Thanks very much for watching. Business Lunch will take all of the action forward. Stay tuned.